Traditional Islamic financing. Interest-free banking. Interest-free banking was first introduced by European bankers. They were aware of Muslim views on riba, but they were run by non-Muslims. Muslim-owned banks were established in the 1920s and 1930s, such as Bank Misr of Egypt and Arab Bank of Palestine, but unfortunately these institutions adopted the practices of their European-owned competitors. The emergence of modern Islamic banking. Three factors were involved in the development of modern Islamic banking in the early 1970s. Number 1. Islamic Development Bank. Finance ministers of the Organization of the Islamic Conference, or OIC, agreed to establish the Islamic Development Bank in December 1973. IDB is primarily a development assistance agency rather than a commercial bank. One of its major roles was to promote Islamic banking worldwide through conferences, seminars, and research. Number 2. The rise of oil prices. They facilitated the development of modern Islamic banking in 1973, and it vastly increased the financial resources. The Dubai Islamic Bank was founded in 1975, the Kuwait Finance House in 1977, the Bahrain Islamic Bank in 1981, Qatar Islamic Bank in 1983, Faisal Islamic Banks of Egypt in 1977 and of Sudan in 1978. The Dalal al-Barakah group of Islamic banks started an investment company in London and banks in these countries: Algeria, Bahrain, Egypt, Jordan, Lebanon, South Africa, Sudan, Tunisia, Turkey, and the Central Asian republics. Number 3. Efforts of the Islamic finance scholars. It is indeed arguably the most critical but insufficiently recognized. Efforts of Islamic scholars to eliminate the prohibited elements, especially riba, must be appreciated. Islamic finance re-engineering. Issues at the initial period. Murabaha was widely used because it is less risky than mudaba, as profit is agreed in advance. Estesna was used to finance projects whereby the bank made advances which could enable suppliers to be paid at each stage of the project. Mushaka was little used as it was deemed too risky. Islamic banks receive most of their funds through current account deposits. They were criticized that they make profits for themselves out of virtually risk-free operations. Similar criticisms were also made on Islamic investment fund movements in the 1980s and 1990s. They invested mostly in the West, with investment decisions largely influenced by risk assessment rather than any notion of Islamic solidarity. Widening the range of products to compete successfully. Initially, many Islamic banks adopted a twofold strategy: to expand their market share and attract further customers. First, they widened the range of services on offer so that their clients could use Islamic banks for all of their financing needs. And second, Islamic retail banks expanded their personal financing facilities. Pioneering the Malaysian market. Malaysia has seen the most ambitious development of Islamic banking in terms of the range of products offered. The central bank encouraged the development of Islamic finance industry to developed instruments and assets. Bank Islam Malaysia was the first institution to be established under the Islamic Banking Act of 1983. Then, larger financial institutions such as HSBC, Standard Chartered Bank, Citibank Hong Kong, Leong Bank, RHB Bank, and Southern Bank became involved. Development of Islamic securities markets. An Islamic securities market makes liquid assets, holds more profitable for Islamic banks, and reduces reliance on interbank deposits. Since Islamic banks cannot hold short-term interest under the Sharia, they have always had a problem in profitability. This problem was overcome by Sukuk Salam Securities Bahrain by providing fixed but interest-free return. This return was calculated in relation to the real benefit the government expects to obtain on the funds. Success of the Bahrain market. The establishment of the Islamic money market in Bahrain resulted in the emergence of markets from the Gulf to Southeast Asia. The Islamic Development Bank has also located its infrastructure fund in Bahrain and also agreed to set up an international Islamic rating agency on the island. Islamic banking in Sudan. Faisal Bank of Sudan was licensed by the government in 1978. The bank's expansion was rapid, and it soon became the second largest bank in the country. Tazamon Islamic Bank became the successful banks, with a network of 22 branches by 1999. By the 1990s, 25 banks were offering Islamic financial services in Sudan, the largest institution being the state-owned Agricultural Bank. The Central Bank of Sudan issued Islamic government certificates with the help of the International Monetary Fund, used for liquidity management purposes. The future of Islamic banking. Financial resources and brand strength of major multinational banks offering Islamic financing facilities ensure that Islamic finance becomes better known to the global financial community. Islamic banking can increase its credibility by introducing common reporting standards. Increasing convergence in Islamic financial practice and interbank transactions between Sharia-compliant institutions will undoubtedly increase client confidence in the industry.